This
anything, or do you have
conference
to
will
hop
now
out?
be
I will be
recorded.
sending out the recording probably later on this week. So anyway, good evening, everybody. My name is Todd Smith. If you don't know me, I am the owner and CEO of Level 5 Financial. So we are hosting kind of our first webinar series of the year, with hopefully more to come in the coming months. So look for your email. Today is really a discussion or the 2021 market review. So we have a guest speaker, Gordon Haave, who will be talking about kind of what's happened with COVID, what to expect in 2021 with the remnants of COVID and how that might impact things. We have a new president that could impact the market. So he has a host of things to talk about tonight that I think you will find helpful. I would suggest if you have any questions, please put in the chat box. We'll have a Q&A afterwards. I imagine the presentation should be about 45 minutes or so with Q&A to follow. So if you would, please just put it in the chat box. Obviously, there's quite a few people here, so if it's germane to your particular situation, your portfolio, I'd recommend that we talk offline. One disclosure beforehand, just let you know that anything that the speaker has to say, you can see it on the screen here, does not necessarily reflect the views of me or anybody here at Level 5 Financial. So I just want to explain that. Our intent is not to give specific investment or tax advice, so we always have to give that disclosure. So anyway, I hope this is helpful for you and you get a lot of good information. Again, question and answer at the end. Go ahead and put questions in the chat box, and certainly give us a call or email afterwards if there's something that wasn't answered. Without further ado, I want to turn this over to Gordon. And Gordon, I believe you should have presenter access to go ahead and control. So take it away. Welcome, Gordon.
Great. Thanks very much, Todd. You guys can see me? Yes? Okay. So thanks, Todd. I appreciate it, and welcome everybody to tonight's presentation. Just as a brief bit of background, who am I? Well, I'm the Managing Director and Chief Investment Officer of FTA Wealth Advisors. We work with Todd, and I'm the former Chief Investment Officer of Asset Services Company, a $4 billion investment consulting firm. Prior to that, I managed $1 billion of fixed income for Devon Energy Corporation, and I'm a chartered financial analyst. Now, we're going to give you a market update here, and really, I'm just going to jump right in. The title of this presentation, which was my year-end review and what's ahead of 2021, is it was the best of times, it was the worst of times. Okay, there's a lot of reasons why, if you're an investor, you can consider these to be bad times, scary times, risky times. After all, we are in the middle of, or just out of, one of the greatest declines in GDP in our history, and certainly the greatest decline since the Great Depression. And things are pretty bad out there. Just an example, you can Google stuff like this all day long. This slide, Yelp data shows 60% of business closures due to coronavirus are now permanent. And unemployment's still through the roof. There are still tens of millions of people who were rendered unemployed due to the pandemic, who have not gotten their job back and may not get their job back. Now, this slide from end of January, of course, shows that daily deaths due to COVID were still high. They have come down since, but things are pretty bad. Now, how bad are they? Are we still in a recession? It's hard to tell. Recessions, official recessions, are recorded after they occur. From an investing standpoint, however, we want to know where we are now. It's usually at least 3 months until either the beginning or an end of a recession is officially recorded, which doesn't help us. Where are we now? Well, there are a lot of different ways to try to gauge if we're still in a recession. One of my favorites is called the GDP-based Recession Indicator Index. Now, you can Google this yourselves. It's on something called the St. Louis Federal Reserve. Just type St. Louis Fed, and you can find this indicator. And according to this indicator, which tries to measure in real time where the economy is, we are in a recession. And the question, just to jump right into this, is what does this mean for investments, for your investments, is as follows. Look, in the first quarter of 1991, was that a good time to buy stocks or a bad time to buy stocks? It was a good time to buy stocks. Third quarter of 1993, good time to buy stocks or bad time to buy stocks? That was a good time to buy stocks. Same thing with the first quarter of 2009. You want to buy stocks when things are at their worst. Now, I mentioned that unemployment's still an issue. Here's a graph of unemployment from the same website. Unemployment peaked in the first quarter of 1983. Was that a good time to buy stocks or a bad time to buy stocks? It was a good time. Same thing in the first quarter of 1993, fourth quarter of 2003, and the third quarter of 2010. So just from those slides, what would you learn? Well, you want to buy stocks in recessions, and you want to buy stocks when unemployment is falling. The absolute unemployment rate doesn't matter. Now, how did we get here? All right. What was the big story? What were the big stories last year that drove the economy last year? Well, the first, of course, was the COVID pandemic. Now, when the COVID pandemic hit, we were all told at the time we needed to flatten the curve. Back then in March, everyone was talking about flattening the curve. You couldn't go on your Facebook or Twitter without someone showing you this graph and explaining we need to flatten the curve. Flattening the curve meant that we need to impose social distancing and other measures to spread the infections out over time so that hospitals don't become overwhelmed, leading to excess deaths. Now, what happened over time is that changed. In the public psyche, for various reasons, that changed to we need to defeat the disease and drive COVID cases to zero. And that's had a profound impact on the economic recovery. Now, where were we going into the COVID pandemic? So usually, I'll try to explain this, usually leading into a recession, building permits are declining. In the red line, which is 2020, we see that building permits were actually increasing leading into the pandemic, suggesting the economy was strong leading into the pandemic. And the same with unemployment. Typically, initial unemployment claims are rising leading into a recession. But in 2020, leading into the pandemic, unemployment claims were falling. One piece of data I like to follow is something called the Citibank Economic Surprise Index, which uses a variety of signals to chart whether economic data comes out surprising to the high level or to the low level. And the Citibank Economic Surprise Index was very positive leading into the pandemic. Now, pandemic hit, and what happened? Commercial paper rates went through the roof, and they're since declining. Why is this important? Well, one of the most important things I've learned in my career is something called the Wickselian cumulative process. The Wickselian cumulative process was discovered, I should say, by a Swedish economist in the late 1800s named Knut Wicksell. And he explained the economy in a fairly simple manner. What he said was that the economy as a whole has a cost of capital and a return on capital. And when the cost of capital and the return on capital diverge, money goes flowing into capital assets. When the cost of capital and the return on capital converge, money goes flowing out. Now, I'm going to go back. Commercial paper is a form of borrowing. It's a way that companies borrow for short-term needs. And you can see that as soon as the pandemic hit, commercial paper went up. That is, the cost of commercial paper went up. So the cost and return on capital started converging. So money came flowing out of capital assets. The stock market went down. Then, as the Federal Reserve intervened in the economy, commercial paper rates went down, the cost and return of capital diverged. So money flowed back into capital prices. The stock market went back up. Now, this was achieved by the Federal Reserve by flooding the market with newly created money, which is achieved through artificially lowering interest rates. This new money is called excess liquidity. Now, usually the Federal Reserve is very slow to react to recessions. Usually, by the time the Federal Reserve starts acting to try to flood the economy with liquidity, there usually takes them about 180 or 200 days after a decline in the stock market before they do so. But this time, the Fed was Johnny on the spot. And that's why, even though when we saw that big dip earlier in the year, things rebounded very quickly in the stock market. Now, going back to this graph, flattening the curve, which we all talked about back in March of last year, that we need to flatten the curve. And flattening the curve specifically says that you can't really do much about infections as a whole. All you can do is try to spread them out over time so that hospitals are not overwhelmed. But everybody forgot about that come April, May, June. And it turned into defeat the disease, to stop infections completely. And that's had a profound impact on the economy. And the question is, why is that? It's very hard to explain. There's a lot of reasons. I'm not a psychiatrist, but I believe a lot of that is that there's a lot of profound unhappiness in the country as a whole. There's the obvious profound unhappiness in, say, the BLM movement. But by and large, there's a large percentage of society, mostly lower wage workers, who don't see the future as brightly as maybe we did when we were younger. And in essence, there was I use the term general strike, a mass movement of people who basically had the idea of shut it down and the government should pay everyone. And this is important. Why is it that such a large percentage of the society is so unhappy right now? And I'm going to go into that for a few minutes. You know, back when I was in school, in high school and college and graduate school, we always learned that the main battling forces in US history and the economy were capital versus labor, or the workers versus the owners. And if you go back to, say, 1989, who was the majority leader in the House of Representatives? It was Dick Gephardt from here in Missouri, who was a union man, all right, claimed to speak for the worker. He was skeptical of free trade and immigration, which, whether you like them or not, a lot of workers are skeptical about. And today, who's the Speaker of the House? It's Nancy Pelosi, a very wealthy woman who rakes in lots of corporate cash, who is very much pro-free trade, and who is very much pro-mass immigration. And what happened in between? Well, what happened in between is traditionally the Republican Party was the party of capital and Democratic Party the party of labor. But starting in the 1980s, so much money was being made in the country by corporations and by the wealthiest, and so much money started flowing into politics that the Democrats realized they had a real problem on their hands, that the massive amount of money that was flowing into Republican political campaigns was threatening to swamp them. And in the 1980s, specifically the late 1980s, Vic Fazio, who was the chair of the Democratic Congressional Campaign Committee, and others basically said within the Democratic Party, hey, we have to start becoming more friendly to capital, to corporations. And what's happened, and why you see a big difference between who was the Democratic majority leader in 1989 versus today, is that the Democrats became more friendly to corporations in order to try to close that fundraising gap. And so what we have basically today, and for the last 30 years, is that there's really one system. That whether it's Democratic or Republican, there's a system that generally believes the same thing. Low taxes, low regulation. Now you might say, wait. The Democrats don't believe in low taxes or low regulation. And what I say to you is, yes, they do, okay? They believe in higher taxes than the Republicans do, and they believe in more regulation than Republicans do. But generally speaking, this is still within a relatively low band. The system believes in the endless wars. Now it's mass immigration, free trade, large military budgets, banking corporate bailouts, which is a big one, easy money, and easy money is the Federal Reserve flooding markets with new money, which tends to end up first in the hands of the banks and the private equity funds. And both parties have essentially abandoned antitrust enforcement, although you now hear some complaints about it in regards to Google and Amazon. Now, meanwhile, we're all arguing about abortion, guns, gay rights, racism, healthcare, religion, all important things, okay? But we're not talking about, by and large, in political campaigns, these issues that the system generally all agrees on. Now, this might sound like a conspiracy theory that, hey, that the people are being distracted from the issues that both parties generally agree on. But the reality is that if you look at, and I suggest you all look this paper up yourself, Testing Theories of American Politics, Elites, Interest Groups, and Average Citizens by Martin Gilens and Benjamin Page. What it says is, in the description is, multivariate analysis indicates that economic elites and organized groups representing business interests have substantial independent impacts on US government policy. Okay, so big businesses and their preferences impact US policy, while average citizens and mass-based interest groups have little or no independent influence. All right, so basically, while we are all arguing about abortions, guns, and so forth, we have really little say on anything, and big business has a lot of say. And what's happened? Well, you can see very clearly that for most of the history of this country, wages went up with productivity. That as workers became more productive, their compensation went up to match it. That started breaking down in the 1970s, and then really right there in the mid-1980s, right when I said that the Democrats started becoming more, their policies more favorable to corporations. Hourly compensation doesn't keep up with productivity at all. And you see, of course, that starting right there in the 1980s, again, mid-1980s, the wealth distribution between the top 1% and the bottom 90% has started going very strongly in the direction of the top 1%. Corporate profits as a percent of GDP, corporate versus labor, corporate and the corporation's share of GDP versus labor's fluctuated for some time. But you see, starting right there in the 1980s, corporations started earning a larger and larger share of GDP. So I contend that this is a lot of why people have been unhappy, why there's so much dissatisfaction in the country today. Now, this, of course, Donald Trump played off of. Whether you like him or not, and whether you believe Donald Trump was sincere or not at all, Donald Trump did tap into that and did start talking about the worker and the people versus the elites, and he started questioning free trade and mass immigration. And if you want an explanation of why Donald Trump became president, whether you like him or not, this, what I just showed you, is the main reason. There's a lot of dissatisfaction out there. So the election played a big part, played a significant part in what's going on with the economy, and people were given a choice between Donald Trump and Joe Biden. Joe Biden, in essence, represented a return to normalcy, and a return to what had been the system for the last few decades. And Biden won, and so we're getting a return to normalcy. And this is all important because what it means is we can reasonably predict government policies and reasonably predict the forces that will shape the economy going forward. Now, one issue we have is that the Federal Reserve's been creating a massive amount of money, well, for many decades, but specifically in regards to COVID, and the federal budget deficit's completely exploded, has again for a long time, but specifically under Trump. And that raises the question, you know, my entire adult life, people have been warning about inflation. Generally hasn't come to pass. Inflation's been generally low since the early to mid 1980s. Now, even at low inflation, that affects you over time. 2% a year over 30 years is a big deal. But we've not had the kind of inflation that we've seen, that we had in the 1970s for some time. And the question is, given what the Federal Reserve's doing, given how much the federal government's spending compared to what it takes in, is there a risk of inflation with these continued policies? And so the best book on the subject is called Monetary Regimes and Inflation by a guy named Peter Bernholz. And he looks back at all 29 hyperinflations of the 20th century. And here's what he found, that in all cases where there was hyperinflation, budget deficits divided by total expenditures were greater than 40%. And the monetization of those deficits, or those deficits were 90% monetized. Now, monetization means that when budget deficits are covered, not by selling bonds, but when the bonds are bought by the Federal Reserve with newly printed money. Now, to be clear, I'm not calling for hyperinflation per se. A lot of people are. It might happen. We need to be prepared for it. But where are we now? All right. The US so far has announced during COVID fiscal stimulus of $2.9 trillion, and we're about to see another at least $1 trillion. But just based on what we've already done, if we assume revenues remain constant over the next year and assume other expenditures outside of the fiscal stimulus remain the same, on this basis, the budget deficit ratio will rise from 30% to 55% in a year's time. The monetization ratio is now about 40%, but that's up from only 0% at the beginning of the year. So going back a slide, I said that hyperinflations happen when budget deficits to expenditures are greater than 40%, and we're there. Monetization of those is 90%, and we're not there yet, but we've gone from 0 to 40, and that 40 number's out of date by a month or two. It's probably closer to 50. We've gone 0 to 40 or a little more in just a year. So it's rapidly becoming a risk. Now, at least in the short term, if you look at this graph of US discretionary spending versus headline CPI or inflation, we see that based just on that, we should be looking at least a little bit of inflation. So maybe not the hyperinflation, but certainly we're looking at inflationary environment going forward. Now, just to be clear, this slide I just picked out for you guys today because it was in the news. Fed Chairman Powell says the Fed is in no hurry to raise interest rates. All right. What does that mean? It only means that the policies that have led to this situation where inflation's a risk are going to continue. Federal Reserve, when they say they have no hurry to raise interest rates, means they're going to keep interest rates artificially low, which floods the market with new money. Now, we're talking about inflation, which we haven't really seen since the early 80s. What does that mean? Well, we got to look at the 1970s. In the 1970s, what asset classes performed the best? Well, commodities, then US Treasuries, then US corporates, then stocks. I'm going to dig into this a little bit more later. But over time, we're allocating our clients to move them up the ladder from equities to corporates to treasuries to commodities. Now, what's the state of the economy today? All right. I talked to you earlier about the unemployment and the recession indicator index suggesting that it's a good time to buy stocks. I'm now going to drill into some macroeconomic reasons why stocks I feel pretty good, despite the fact this slide showing that equities have performed poorly in the 1970s. I told you that the Federal Reserve has flooded the economy with liquidity in response to COVID. And you can see that in this graph. This is a graph of the money supply, and it went through the roof. The year-over-year change went through the roof in March and April. Now, when the Federal Reserve creates money and creates new money to create liquidity, that money goes to on the balance sheets of the banks. It only really enters into the economy when banks start lending that money out. And you can see in this slide, there was surging liquidity, but up through the third quarter, the economy itself, although it recovered after the initial shock, was still sort of languishing a little bit. And of course, with GDP numbers, we're always 3-4 months out, so we don't know exactly what it is today. So the question is this money, this excess liquidity, making it back into the economy? Well, first, let's take a look at this. This is US personal savings as a percentage of disposable personal income. As soon as COVID hit and the lockdowns hit, people started spending a lot less money, but that ended pretty quickly. People are spending again. This is a graph of US industrial production. Industrial production's in black, leading indicator in red, advanced 6 months. And we see that the leading indicator showing that we're likely seeing or going to see surging US industrial production. People are also buying houses, all right? Leading indicators show a recovery in home buying, and most of you in your neighborhoods have probably seen the same thing. People are spending money. When people spend money, and industrial production from the last slide, when industrials pick up their production, when people spend money on houses, they usually borrow for it. What does that mean? All that extra cash on banks' balance sheets is getting lent into the economy. See the same thing with auto sales. Most people borrow when they buy cars, and auto sales are surging. US CapEx, capital expenditures are surging. Business spending on business equipment is up, and the leading indicators show that it's going to continue. And we can also just go straight to the horse's mouth. Here you want to look at black, and on the black line, there is an actual loan officer survey. How do loan officers feel about extending new loans? And they tightened up real quick during the beginning of the pandemic, but they're loaning money again. So all of that built up money on the bank balance sheets due to Fed liquidity is entering into the economy. What does all this mean? We talked about commodities being a pretty good place, and looking at commodities. Commodities index in black tracks excess liquidity pretty well. Excess liquidity is surging. We expect commodities to outperform. Drilling down a little bit, this is especially true of copper. Copper prices are rising, and the leading indicators are very, very strong. Same thing with oil. Oil's prices have recovered, and the leading indicators are strong as well. And we see the same thing for industrial metals. This is another way of, sorry, this is the exact same slide. I'll have to talk to someone about that. All right, what does all this mean for the S&P 500? S&P 500 earnings per share tracks manufacturing new orders. We just went through all the slides. There's increased industrial production. Manufacturing new orders are up. S&P 500 earnings per share should be surging. There's also been a lot of money on the sidelines. When the pandemic hit, a lot of asset managers, investors, and individuals took money out of the capital markets and put it in money market funds. That money is starting to flow out of money market funds. Most of it works its way into the stock market. If we take a look at the average of money market funds in 2009, which is in black, once we hit peak money market funds, it took an entire 180 weeks before that trend changed. So typically, once money starts coming out of money market funds, most of it goes into the stock market. That trend keeps going on for a while. Where we are right now is the red line, and I'm pretty confident we're going to keep seeing money flow into the stock market. Now, does it matter which stocks you're in? Yes, it does, and we'll start talking about that. A lot of stocks are very, very highly priced, and you probably know this. You go into the newspapers, you watch on TV, you see Amazon and Apple and the big tech stocks have been leading for quite some time. Now, information technology and communication services have been increasing as their share of the economy for some time. The trend, the percentage of tech and internet, the total S&P 500, the trend is the black line. It's been going up for some time. But where the red is right now, we see it's really way above the trend line, suggesting perhaps that internet and tech stocks, after this long run, finally might be a little bit overpriced. If we look at S&P Information Technology versus the 10-year Shiller CAPE, CAPE is cyclically adjusted price to earnings. That is, how much are you paying for earnings in stocks? We see that the S&P Info Tech CAPE is way above trend as well. Just another sign that perhaps this multi-year run of the tech stocks really outperforming might be getting a little bit pricey now. And something else that's troubling is in the technology sector, there's now over $1 trillion of market cap that has negative earnings. So companies that don't even earn any money are now worth over $1 trillion. So after this long run, and we've done well in some tech stocks, it's time to start being a little bit worried that that rally is not going to continue. Now, where do we want to be? For many years in my whole career, there's value stocks, there's growth stocks. In some periods, value does well, and some periods, growth does well. It's been a growth story for 10 years. Nobody talks about so-called value stocks anymore. Well, how are stocks valued? Look, in the long run, and we all know every day stocks do all sorts of crazy things, but in the long run, stocks are valued as the present value of their future cash flows, discounted back at some rate, 10-year treasury rates or an inflation rate. And in growth stocks, stocks that have no earnings, but people think, boy, 10, 15, 20 years from now, they're going to be worth a lot of money. You're discounting back those 10, 15, 20 years. But value stocks, say energy stocks, industrial stocks, where a lot of their assets are in plants and equipment or oil in the ground, you're discounting back fewer years. Now, we talked about inflation. Inflation is going up, at least a little, possibly quite a lot. What that means is that discount rate's going up. So on value stocks, we're only discounting back a few years. The increase in that discount rate doesn't affect them that much. But on growth stocks, stocks that people aren't thinking are really going to make any money for 20 years, that increase in inflation really should impact the valuation. So we have a value versus growth tilt. Now, COVID's been a big story. COVID, however, now is looking pretty good. All right? The number of states where COVID hospital admissions are rising is very, very few. This data is as of 2 weeks ago. Vaccines are getting out there. There's a lot of complaints about how well the United States is doing, but we're in the top 5 or 6 countries for getting vaccines distributed. And so one of the big worries for the stock market would be, well, what if there's another lockdown? And that was certainly leading up to the inauguration. A lot of people were worried about that. A big part of the presidential campaign was, but Trump's biggest weakness in the presidential campaign was his perceived handling of COVID. So there was a lot of concern that a Biden administration might want to do something drastic and try to impose a 30 or 60-day lockdown. And I just don't think that's going to happen. Right when Biden took office, Biden unveiled a national pandemic response. And from that, we see that the new president intends to make expansive use of his executive authority to sign a dozen executive orders. Now, what were they? Right. Banning requiring mask wearing in airports, certain modes of public transportation. Well, when was the last time you were in an airport and nobody was wearing a mask, or on a train? And this is important because what it means is that they're not going to, they're really doing nothing. They put out a press release, we're doing all these executive orders, but they're really doing nothing because requiring masks in airports isn't that big of a deal. And that's important because it's a good sign that the Biden administration's intention is not to impose another lockdown. If it was, they would have wanted to do it right away in order to then get over it as soon as possible, 30 or 60 days later. So I'm overall bullish on the stock market. Now, we need to have a value tilt, and we need to be bullish on commodities, including energy. It also means emerging markets. Why? Because emerging markets are very commodity focused. And that's important because I showed you the graph earlier about how asset classes performed in the 1970s, and that stocks didn't do that very well, at least adjusted for inflation. But some stocks did, all right? Value stocks outperformed growth, but most importantly, the commodities and energy did very well. And emerging markets will do well also as long as commodities do well. So that's the gist of it. Stay bullish, but this inflation threat is real. We are migrating our portfolios slowly up the food chain and into commodities and energy. And that's it. Does anyone have any questions?
Let me check the chat box here, or you can unmute yourselves if you have a question. I have a few here if nobody does. So Gordon,
I'm here.
Who's that?
Sorry, it's Dennis. I'm here.
Oh, Dennis. Hi. Do you have a question?
No, I'm sorry.
Okay. Gordon, could you speak a little bit more in terms of the run-up of technology, specifically large cap growth, and there's been some talk of that mirroring the late 90s in terms of the precursor to .com. You seem to underplay a little bit the valuation issue, maybe not, but could you dig into that a little bit more for us?
Sure. So I showed a few graphs showing that tech is expensive, perhaps pricey compared to its trend. I think, and I also showed a graph that there's over $1 trillion in market cap of companies that have no earnings whatsoever. And that all sounds very scary. Now, what I would say, though, is that one big difference between now and the late 1990s is that the biggest companies, Apple, Amazon, Google, they actually make a lot of money. Okay. And in the 1990s, a lot of those leading players didn't make any money at all. So where we are in the tech sector is, I'm not saying bail out on it, but you need to be focused. Your allocation needs to be to the leading companies that actually make money and avoid very heavily the companies with low to no earnings.
Okay. So from the value versus growth, we've been advocating, overweighting value for a while. For the most part, we've been neutral in the sense that, we've accepted the cyclical nature of value versus growth, in favor, out of favor. How much are you advocating an overweighted value at this point?
So what we typically do, because our clients, of course, are in or near retirement, we're not talking big bets. We have large diversified portfolios, but what we've been doing in advocating is taking 10 to 20% of your portfolio and putting it into this value, or what we also call reflation play, to try to capture that. So 18 months ago, when it was clear that the large tech stocks were going to continue their run, we did the same thing and advocated putting 10 to 20% just to grab some of that extra run that looked like it was coming up in the tech stocks, which did. So same thing, should take a bit of your portfolio, position yourself that way, be a little bit careful about a lot of these tech stocks.
Okay, thanks. So in light of that kind of transitions to another question I got from somebody. What if you're transitioning into retirement now, or sitting in a lot of cash? So I think a lot of us are still a little gun shy from last spring. We're still feeling unsure with the rollout of vaccines and the stability of the economy, et cetera. What are your suggestions around that topic?
Sure. So obviously, I don't know any of your individual situations, and that's what you should talk to Todd about. But a big mistake that people make, of course, is waiting for the all clear signal. And one of those first few slides I showed you on the GDP recession-based indicator, as well as the unemployment graph, was that you really want to buy when there's blood in the water. That if you wait until it's all clear, you miss a lot of the resulting gains. And so I do believe that, obviously within a financial plan that Todd helps you out with, I do believe that you should be invested with a nice weight to this value and what I call reflation, and being very careful with the tech stocks.
So a question just came up in the chat box. I think you would agree or you would say yes to this, but do you expect 2021 to be a good year for investing? So I think there's cautionary optimism is what I'm hearing from what you shared so far.
Yeah, so one of the things I always say is, I have no idea what the stock market's going to do tomorrow, all right? I don't think anybody does. What I do believe strongly is that over what I would call the medium term, 6 to 18 months, I'm very, very positive on the stock market, particularly if you have a nice little weight to the value and reflation, and being careful on the tech side.
So as you know, our shared client base typically is not all invested in the stock market. Frequently, it's going to be 40, 50 on the high end. Can you speak to the fixed income component and maybe the fallen heroes and kind of some of the media highlights we heard last year, and what
Sure.
concerns you have? Yeah.
No, that's fine. Most people like to hear about the stock market. Fixed income, of course, is tough. So the Federal Reserve has a specific policy of driving interest rates lower and lower and lower and lower. You can agree with that or not, but that's their policy. It makes it very hard to earn money in fixed income. And of course, as interest rates come back up, which they've done a little, then you have a drag on your investment performance. Within your fixed income allocation, though, you should have a slug of high yield fixed income. High yield fixed income outperforms treasuries and corporates over time. The risk is when you enter a recession, they go down a lot more. But everything we're seeing with the revival of industrial production, with the revival of the energy sector, is very bullish for high yield debt. So much high yield debt is energy companies. A lot of it is industrial companies that have languished for a couple of years. But in this scenario, you should have high yield as a portion of your portfolio within, of course, all of your individual risk tolerances and circumstances.
So do you see the downgrading of debt as a concern going forward?
No, I think we're going to see upgrading.
All right, thank you. What else? Other questions we have here? So speaking of headlines, we hear a lot about Bitcoin, right? So I'm sure you talk about it a dozen times a week. So from our coffee talk, I think we had last week or the week before, somebody brought up a question about Bitcoin. Somebody also brought up BTC. So I guess twofold. What is your feeling on Bitcoin and maybe all the cyber currencies in aggregate? And then the other more specific question was, do you see Bitcoin having an effect on the money supply?
Yeah, so my opinion on Bitcoin is mostly fairly negative, which is I simply don't believe that the government and the Federal Reserve and the governments and central banks of the major countries are going to allow Bitcoin to replace the money supply or to have a significant impact on the money supply. And they can put an end to it with the stroke of a pen, all right? When Bitcoin started out, and 5 years ago, I had some Bitcoin, a friend suggested I buy some, just a few $1,000s. But when Bitcoin started out, well, what would you do with it? Okay, you can send it to somebody. There was a travel agency that you could book an airline ticket, and that's what I did with mine. But it was limited in what it could do. Now, with Bitcoin, you can do a lot more. But here's the thing, at the end of the day, Bitcoin only works if you can readily convert it to US dollars or euros or something like that. So you need these Bitcoin exchanges to do that for you. The government, with a stroke of a pen, can tell the banks to stop doing business with the Bitcoin exchanges, right? So I think the risk is great. I mean, we're talking about a business basically where the government can practically end it at any time. And then on top of that is, yeah, I think they ultimately will. The supremacy of the US dollar in the transaction system is paramount to the system. And I simply don't think they're going to allow this to get to be that much of a bigger thing. So I'm very concerned about it. Now, there are other ways to play it. I talked about larger tech stocks I'm okay with. In our NASDAQ leaders portfolio, we have NVIDIA. Well, NVIDIA's largely a Bitcoin play. NVIDIA is making most of the chips that people are using to drive Bitcoin. So there are ways to get some exposure that way, but I certainly don't believe you should have a significant weighting in your portfolios to Bitcoin. I'm all for buying a few $1,000s and having fun and getting interest in it. Go ahead, I've done that myself, but I don't think it's going to last.
So maybe an ETF, if they have one or two out there, might be to get broad exposure to crypto in general.
Even that, that scares me. Certainly not as a part of making sure your retirement's secured.
Yeah. So I think I share your sentiment on that. It's good to hear that. What would you say to somebody that maybe has gone down that road, or as a child that's doing quite well with Bitcoin or got lucky with GameStop? What kind of conversation would you recommend around that? And it would mirror mine, but I just thought I'd ask. Yeah.
Hey, with Bitcoin at where is it? I forget. I didn't see where it closed today, but where Bitcoin is where it is today, I would absolutely sell it. if you've got kids who are trying to mine Bitcoin with computers and having fun, hey, I'm all for that, right? Why not learn about things? But it's had an incredible run up in price, and anybody who's had Bitcoins a year ago and they could sell them today at this price, absolutely, that's what I would suggest.
Okay, great. Anybody else have any questions? I think I'm trying to see what else was emailed to me. Let me check the chat box here. No, I don't think we have any more questions. So I guess we'll end early a little bit. Gordon, I want to thank you very much, Gordon, for taking your time to do this. In case you're wondering, Gordon and his firm is kind of a partner firm of ours. They're out of Missouri. And I just, again, thank you so much. If you have any questions, certainly email me or call me at 719-323-1240. We will have a recording of this probably on our YouTube channel, but also sending it out to everybody who attended and probably most of our clients as well. So again, one more call for questions. I don't see any. Thank you all for attending. Gordon, did you have any closing remarks?
Nope, thanks to see you. Good to see you again, Todd. And for everyone else, thanks for attending. And get together with Todd, make an appointment, go over your situation, and we'll put something together for you.
Okay, thanks, Gordon. Thank you, everybody. We'll see you next time. We have our coffee talk and our happy hour coming up the beginning of March, so look for emails on that. And we'll be following that up with probably our second webinar series, the end of the March, which would be estate planning. Looks like April will probably be advanced tax planning. So we'll continue to have hopefully valuable events each month. If you have specific topics or suggestions of what you'd like to see or speaker, let us know. I haven't announced it because I haven't heard back, but I reached out to the FBI. I thought that would be neat to have a speaker from the FBI, but they must be checking my background because I haven't heard from them yet. So anyway, I'll keep you posted on future events and speakers. Thank you all for being here. Have a great night, and we'll talk to you soon. Take care.
Thank you. Thank you, Todd.
You're welcome. Take care.
Thanks, Todd.
Thank you.
Good to see you. This is Ginny and Laird.
See you, Ginny and Laird. We'll talk to you soon. Thanks for coming.
Bye.
Hi, Frank.
Hey.
I'm going to stop the recording here.